In 1661, a French finance minister named Nicolas Fouquet did something that would accidentally end his entire life. He hosted a party so extravagant that it didn't just impress the King of France, it humiliated him. 17,000 guests, gardens lit like daylight, fireworks designed by artists who would later build Versailles itself, tables so overloaded with gold and crystal that even seasoned nobles couldn't process what they were seeing. And at the center of it all, Fouquet wasn't just showing wealth, he was showing superiority. There's a moment in history that most people miss here. King Louis XIV, just 22 years old, sits in silence during this event. Not impressed, not entertained, threatened. Because for the first time, he isn't sure whether his own finance minister is richer than the crown. 3 weeks later, Fouquet is arrested. No trial that mattered. No escape. No negotiation. He spends the rest of his life in a fortress prison. And here's the uncomfortable question almost nobody asks. How does someone go from the height of wealth to total collapse in under a month? Now fast forward to early America. Robert Morris wasn't just rich, he financed the Revolutionary War. If you've ever thought about the American founding as a heroic story, Morris was one of the people quietly paying the bills behind it. He had influence, money, status. And yet he died broke. Not lost some wealth broke. Boarding house, forgotten. Nothing left. 2 completely different centuries. 2 completely different men. Same outcome. And that's where the real story begins. Because this isn't about bad luck. It's not about mistakes. It's about something almost nobody understands until it's too late. Wealth doesn't grow in a straight line. It moves in stages. And each stage changes the rules of the game completely. Most people never realize when they cross those stages, which is exactly why most people stay stuck. Now before you assume this is another motivational finance story, it's not. What I'm going to show you is something far more uncomfortable. There are exactly 3 financial thresholds that quietly control almost everything about your life. And once you understand them, you stop thinking about money the same way ever again. But here's the catch. Most people don't fail because they don't make enough money. They fail because they apply the wrong strategy at the wrong stage. Let that sit for a second. Same income, same effort, same intelligence. Different outcome. Just because of timing and structure. Now let's go back 600 years. Because the first people to figure this out didn't have spreadsheets, index funds, or financial advisors. They had observation. And one family in Florence saw something everyone else missed. The Medici. They started as wool traders. Nothing special. Middle class by the standards of their time. No dynasty, no guarantee of success, no special advantage. But Cosimo de' Medici noticed something strange about money that most people never see even today. He realized that wealth stops behaving normally after a certain point. Below that point, money is fragile. Every decision feels dangerous. Every loss feels permanent. Every mistake feels like it could end everything. But above that point, something changes. Money stops being just survival. It becomes leverage. You can survive mistakes. You can take risks other people can't. You can walk away from bad opportunities. And most importantly, you can wait. That last one is where everything changes. Because poor and middle-level wealth is reactive. You say yes because you need to. You take deals because you can't afford to wait. You accept opportunities because uncertainty is dangerous. But at higher levels of capital, you don't need to react anymore. You can choose. And that single shift quietly separates everyone who builds wealth from everyone who doesn't. Cosimo identified 3 stages, not as theory, as behavior. And those stages still exist today, just with different numbers. Let's start with the first one, because this is where almost everyone gets stuck. The first threshold is around $100,000 in investable assets, not net worth on paper, not house equity, not theoretical value. Liquid, working capital. Now here's the part nobody likes to hear. Below this level, compound interest is technically real, but practically invisible. At $10,000 invested, even strong returns feel meaningless. You make maybe $800 a year. That doesn't change your life. At $50,000, you're still looking at a few $100s a month at best. Still not enough to feel different. Still not enough to change behavior. And this is the trap. Because psychologically, nothing feels like it's working. So people quit. Or they reduce effort. Or they delay investing until later. But then, something strange happens right around $100,000. The math doesn't change. But the experience does. Now your investments generate real, visible money. Not symbolic. Not theoretical. Noticeable. A bad market month doesn't erase everything anymore. A good month actually feels like progress. And something even more important happens. Your job stops feeling like total dependency. Not freedom. But pressure starts to lift. You negotiate differently. You make decisions with less fear. You stop optimizing your life purely for survival. And this is where most people underestimate this stage. The first $100,000 isn't about wealth. It's about identity change. You stop acting like someone who is financially fragile. But here's the uncomfortable truth. This is also the hardest stage in the entire system. Not because it's mathematically difficult, but because it's psychologically boring. Growth is slow. Results feel delayed. Effort feels disconnected from reward. You contribute more than your money earns for years, which is exactly why most people quit here. They assume it's not working, when in reality, it's just not visible yet. Think of it like filling a pool with a garden hose. For a long time, nothing looks different. You stand there watching water spread thin across the bottom. It feels pointless. But the moment the depth starts building, everything changes. Now let's move forward. Because once you cross $100,000, the next stage arrives faster than people expect. The second threshold is around $500,000. This is where things stop being theoretical. At this level, even conservative returns start producing meaningful annual income. But the real shift isn't income. It's protection. At $500,000, something psychologically powerful happens. You are no longer financially fragile. You don't need your job the same way. You still work, but the fear is gone. And fear is what controlled your decisions before this point. Most people don't realize how much of their life is built around avoiding disaster. Staying in bad jobs. Avoiding risks. Accepting poor treatment. Not because they want to, but because leaving feels dangerous. At $500,000, that calculation changes. You gain what can only be described as walk-away power. Not because you will leave, but because you can. And that distinction changes how people treat you. Ironically, it also changes how you behave. You become more valuable without changing your job. Because you stop operating from desperation. Now here's where it gets even more interesting. At this stage, your money starts working harder than your contributions. The system begins to accelerate itself. What used to take years starts compressing. Because now you're not building from scratch anymore. You're compounding on a foundation that is already active. And this is where people either stabilize or sabotage themselves. Because history shows something consistent. When people reach this level without understanding it, they often panic during downturns. They see temporary losses and react like they're still at stage 1. They sell. They exit. They lock in fear. And they destroy years of progress. Not because they lacked intelligence, but because they never updated their mental model. And that's the hidden danger of every threshold. If your thinking doesn't evolve, your behavior breaks your progress. Now let's move to the final stage. The one that changes everything. The third threshold is around $2.5 million in investable assets. At this level, something fundamental inverts. Because now your money earns more than your labor. Let that land properly. You are no longer primarily paid for your time. You are paid by your capital. At even moderate returns, This level of wealth generates six-figure annual income passively, which means the logic of work itself changes. Before this point, time is your most valuable asset. After this point, capital is. And once that flips, decisions that used to make sense stop making sense. Working extra hours for marginal income no longer moves the needle. Trading time for money becomes inefficient, not emotionally, mathematically. This is why wealthy people behave differently. Not because they are detached from work, but because they've already done the calculation most people avoid. And here's the final uncomfortable truth. Most people never reach this stage through income alone, because salaries scale linearly. But wealth at this level requires asymmetry, ownership, equity, compounding assets that grow independently of labor, which is why the system quietly encourages consumption instead of accumulation. Because consumption keeps you cycling, while ownership removes you from the cycle entirely. And this is where the original story connects back. Fouquet confused visibility with safety. Morris confused wealth with permanence. Neither understood the stage they were in, and both paid for it. Because every level of wealth has rules, and ignoring those rules doesn't keep you safe. It just delays the consequence. So the real question isn't whether these thresholds exist. It's whether you're building in a way that respects them. Because time will pass either way. The only variable is whether you cross them deliberately, or accidentally stay stuck between them.